As the tech inferno rages on, how much worse can it get? What do you do with tech, Guy?
Well, Mel, I think how much worse can it get in terms of the S&P? I think another 4 or 5%. A few weeks ago, when the S&P was down 5%, you turned to me, you said, what do you think? I said it can go down another 8 or 9% from here. 14% makes about sense. In terms of where it puts the S&P, it puts it at 25-30. Now, we've sort of vacillated back and forth, but I still think that's in the radar screen. Now, I'll say this quickly. You know, some of the market has changed. Like, the feel of the market has definitely changed. And quite frankly, it started with Netflix that reported what was a pretty strong quarter. You saw a huge move to the upside. And look what Netflix done over the last couple weeks. Point being, good news is being discounted. Bad earnings reports are being throttled. And that's an environment change. So I do think you could see 25-30 to the downside in the S&P 500.
Yeah, so I think it has a lot to do with the fact that there's just unusually positive sentiment in a very small amount of names that made up a disproportionate amount of the indices that they're in, and we know what these names are, and also the performance so all year long, making up for these small group of mega cap tech names that, you know, you forget at one point this year, Netflix was up 50-60% in the year. Amazon was up 60% or so. It's still up 30%, although it's down 20%. So I think what happened here is investors said this might be as good as it gets, and they all headed for the door at the same time. That's why we still have this market where we have so many names that are obviously in correction, or what a lot of people would call crash territory, and it's not going to end. Listen, the way NVIDIA closed on its second down day, closing on the dead low 2 days in a row like that, that's bad news. You do not want to try to catch a falling knife like that right now.
It seems like nobody's buying on the dip. So we're seeing all these pullbacks, right? And before, investors have been conditioned to go in and buy when it's down. We're not seeing that necessarily anymore.
And in fact, I think there's been a couple good notes. Morgan Stanley, most notable, that had, buying on the dip has not worked in 2018. So it's actually been a big failure. Dan talks about, where the index actually isn't really showing the pain that's below the index, because actually, and maybe actually the difference is about to happen if you get these juggernaut stocks continue to sell off the way they are, which really make up a big component of the index. I would go back to, you should be watching rates right now. 305 in the 10-year, we're continuing to tell you that the market does not believe that that the economy is either as strong or is that the Fed will take us further. Fed expectations for December, by the way, continue to slip. We're at about 70% that they will go in December. And by the way, that could go to 50-50 if you consider the way the market's going. Housing numbers this morning were terrible, Pete.
Mike Wilson was so great, and it was right in front of all of this, right, from Morgan Stanley. Right. He got out there and on this, sat right here talking about how he viewed the market itself. And he talked about the idea that he thought tech was going to drag us down. He's been exactly right. Now he seems to be a little less bearish, but he's still there. He's not saying, hey, it's time to just go in and start buying. So I think that is a concern. The concern also is that people got burned enough times trying to buy the dips, and now all of a sudden that's not working. So that's a real problem. But I still think you look for quality. I think there are opportunities out there. I'll give you a great example, something like an NVIDIA. Now, when it was trading at 60 times, everybody loved it at 200. We talked about that earlier today. $200, God, they love NVIDIA. God, they do everything right. They're in crypto. They've got this. They've got that. Data centers. And now they've decelerated a little bit in data centers, right? So that was the problem. That was part of what
crypto.
And crypto.
Gaming.
Revenues dipped significantly in terms of the projections for Q4. But you know what? At some point, I'm not saying it's yet, and Guy's better with the technicals than I am, but at 145, it now trades at 18 times earnings. It's finally something where I think you can look at a name like that and say, you know what, at 18 times, maybe it is a buy. I haven't bought it yet, though. I'm still in Intel.
But you're looking.
Well, it's interesting. So I called in the show Thursday, by the way.
Thursday.
The snowstorm. What a disaster. I mean, that's an aside.
If any of our elected officials watch Fast Money, they shouldn't. Quite frankly, they shouldn't be. They should be doing their jobs. But if maybe they're taking a break and they happen to be watching right now, I encourage you to sort of be prepared next time there is a storm, because in the Northeast, we actually get these from time to time. That being said, on my 6-hour car ride,
your 6-hour car in which you didn't go anywhere. Actually, you left your house.
You got down
and then you went back
block.
to your house.
It was unbelievable.
Anyway,
went nowhere.
That's an aside.
But we called in and said, Guy, what do you think about NVIDIA? It was 5:30 on the show. I said, you know what? The fact that they got it down as much as they have, stock overshoots to the upside. I think it's going to overshoot to the downside. And my downside target was about 138. So to Pete's point, now you're within a whisper of that stock being interested again, not only on a valuation basis, but on a technical basis.
Yeah, so why has buy the dip not worked in 2018? I think a lot of it has to do with the fact that the fundamentals for these companies are changing. When you think about it, everyone was focused on a couple of names getting to $1 trillion in market cap, these massive product cycles that were doing it, and they were buying back stock, and the global economy was getting better. All that. That's how we started the year. and then we went down in a straight line, and then we spent most of the rest of the year getting back to those prior highs. What's happened in the last 2 months? We've seen some chinks in the armor of these stories that you couldn't find them in prior. And let's just name them, okay? Amazon guided this quarter down. We're not going to know until January when they get their holiday sales if they have to do it again. If so, that stock's going back to $1,000. Apple, they had bad iPhone guidance. We all knew it was going to be messy, but if they don't achieve the units in this sector, we're not going to know also about the units, and it's going back down. I mean, that's the story. The fundamentals have kind of changed. These companies are very mature now, and they were trading at kind of some peak levels, margins, and valuation.
So what do you do in this market environment in which you have the slaughter of these tech giants, which had been market leadership prior, and then you have names like Coca-Cola trading at its highest level since its IPO back in 1919?
Well, it shows you that there's still a lot of money that needs to stay in the market and needs to find a place to go. McDonald's has been outperforming. Starbucks has been outperforming. These are companies that also, seem to be actually getting through either higher input costs or don't have big trade fears. You talk about what's changed fundamentally, Dan. What's changed is that actually the trade fears really have affected the business. When Apple tells you that emerging markets really are starting to struggle, and this is where they're going to sell some of those lower priced phones, it's a big deal. So I agree that the places to hide are becoming fewer and farther between. But I do think stocks below the surface have removed an enormous amount off of the valuations. And I still think some of the big industrial names, their businesses are not over. And I think actually they've really been priced almost to destruction.
And that was one of the other things that Mike Wilson talked about is the fact that in the last year, you're down 18% from where the PEs were a year ago. So you're starting to see opportunities out there, and maybe that means that there are some names that can start to outperform that weren't before. I mean, how many years have we talked about Coke on this desk or Pepsi or some of these where they just haven't had that performance?
Yeah.
J&J's and some of the pharma names have. J&J is another one of these names that's been very impressive on these down days, and they're not going there to hide, I don't think. I think there are different elements of what J&J and some of those are offering that gives them the opportunity for pricing power,
but
right?
could anyone on this desk sit here and say, yes, you should be hiding out in Coca-Cola?
You don't hide
now.
anywhere.
No, but what I'm
know.
saying is, it's like, no, but that's the only reason why these stocks are performing right now. They're considered staples. Look at how McDonald's and Coke and some of this stuff is acting. I mean, to me, I don't think it makes a lot of sense when the market is now very focused on valuation of growth names, of companies that have just changed the world, and you want to go and buy sugar water stocks. It makes no sense at 22 times.
Well, that, and shouldn't you think about the valuation of these quote-unquote value stocks or the defensive stocks?
Some of them got too high.
Look a little stretched right now.
Well, quickly, I mean, unravel this. You mentioned pharma. Big cap pharma has been trading well. It has not been a place to hide. It's actually been a place to be.
There's
and
growth.
we've talked about that for a long time. Pfizer, since President Trump went after them in the spring, I think, when the stock was trading 37.5, has basically been a straight line to the upside, moves we haven't seen in Pfizer in probably the last 10 years. Procter & Gamble, on the other hand, I don't know. I mean, I think people are racing to it for some perceived safety. But at 20 times forward earnings for Procter & Gamble, is that really where you want to be? I don't think so.